Right now, over 1 million Americans are sleeping on the streets, in cars, or in temporary shelters. If you turn on the news, you are told that this is a tragic side effect of inflation, a lack of personal responsibility, or just a bad economy. But inside the air-conditioned boardrooms of Wall Street, it is viewed very differently. To them, homelessness is not a crisis. It is a mathematical certainty. It is a highly profitable, carefully engineered feature of a billion-dollar algorithm designed to create artificial scarcity. Today, we are going backstage to break down the exact math they desperately want to keep hidden from you. For decades, the housing market was governed by a simple, natural law: supply and demand. If a landlord wanted to fill a building, they had to offer a price that the local working class could actually afford. But that natural equilibrium has been quietly hijacked by an invisible, centralized AI cartel. The reason your rent is unaffordable isn't just because there's a lack of physical houses. It is because of a coordinated, machine-led effort to price-fix human shelter. In May of 2026, the veil on this operation was finally lifted when 14 major corporate landlords paid out a staggering $360 million in federal settlements regarding their use of a software called RealPage. The Department of Justice exposed exactly what this software was doing. It acted as an algorithmic cartel, allowing nominally competing landlords to illegally pool their sensitive, non-public data. Instead of competing for your business, they outsourced their pricing to a centralized intelligence that artificially inflated rent prices across the entire country simultaneously. By operating as a monolith, they broke the fundamental law of capitalism, forcing millions of Americans to pay exorbitant premiums just to keep a roof over their heads. But the most terrifying part of this software wasn't just that it raised prices. It was how it reprogrammed the fundamental goal of property ownership. You might think that jacking up rent would backfire, leaving landlords with empty buildings and lost revenue. But Wall Street's algorithm proved the exact opposite, ushering in the most twisted mathematical formula in real estate history. To understand this new era of real estate, you have to completely unlearn the traditional logic of being a landlord. For a century, the golden rule was occupancy. Keeping a building 100% occupied was the only way to maximize profits and keep the bank happy. But the new algorithmic math, exposed by the sweeping DOJ antitrust lawsuits, killed that logic entirely. Corporate landlords discovered that they actually make significantly more money by jacking up the rent to astronomical, unpayable levels and intentionally leaving units vacant. The software proved a dark paradox. Keeping a sprawling apartment complex at 80% occupancy with artificially hyperinflated rent yields substantially higher total revenue than keeping it fully occupied at a fair, market-driven rate. The algorithm specifically trained property managers to ignore down market conditions and accept higher turnover. It treats vacant units not as a failure, but as a strategic buffer to prop up the massive costs imposed on everyone else in the building. But what happens to the vacant 20%? Those aren't just empty rooms. Those represent actual human beings, families, and workers who are effectively pushed onto the streets to subsidize a profit margin. The math actively weaponizes displacement to maintain its yield. Engineered scarcity works flawlessly for high-rise apartment complexes, where data can be easily pooled and centralized. But Wall Street was not satisfied with just dominating the rental market. They wanted to financialize the American dream itself, setting their sights on the single-family home. As the public started to wake up to this reality, a massive backlash began brewing. Politicians and housing activists began accusing Wall Street of buying up all the houses and destroying the middle class. But the corporate PR machine was ready, immediately firing back with a seemingly bulletproof defense designed to make you think you were overreacting. If you listen to hedge funds and private equity firms, they love to publicly recite a very specific statistic. They point out that institutional investors own roughly 450,000 single-family homes across the country. That sounds like a lot, but they are quick to remind you that there are 82 million single-family homes in the United States. Mathematically, they argue, they own a mere 0.55% of the market. They go on television and claim they are just a drop in the bucket, entirely incapable of causing a nationwide housing crisis with such a microscopic footprint. And on a macro level, That math is technically true, but it is also a deliberate, brilliantly engineered illusion. If they only own 0.5% of the market, how could they possibly be holding the American housing supply hostage? Because that 0.55% is a mathematical distraction from the hyper-targeted, laser-focused strategy they actually use to silently suffocate first-time buyers. They aren't buying randomly across the country. They are deploying military-grade data to orchestrate localized monopolies, and the reality on the ground is terrifying. Wall Street does not care about national averages. They use advanced predictive data to identify highly specific, vulnerable, high-growth neighborhoods. They look for areas where Millennial and Gen Z families are trying to buy their very first starter homes. Then they swarm. Corporate buyers flood these precise zip codes, deploying billions in untraceable cash to buy everything in sight, effectively cornering local markets and entirely removing everyday buyers from the equation. When you zoom in on these institutional hotspots, the 0.55% myth instantly disintegrates. Look at the data coming out of Houston, Texas. In specific, highly desirable zip codes, real estate data reveals that corporate buyers have clustered their purchases so aggressively that they captured up to 73% of the available single-family inventory. They aren't a drop in the bucket. They're a localized tsunami. By controlling the vast majority of the inventory in a specific area, they dictate the floor price of living there. They turn neighborhoods of homeowners into transient communities of permanent renters, completely severed from the ability to build equity. So, Wall Street controls the apartment rent through a cartel algorithm, and they have successfully monopolized the starter homes in growing cities. The trap is perfectly set. When everyday families inevitably fall behind on these engineered, mathematically inflated costs, the machine does not offer a shred of grace. It simply initiates the next cold, calculating phase of the equation. In the past, if a family hit hard times, lost a job, or faced a medical emergency, they had a chance to plead their case. A human landlord might negotiate a payment plan, understanding that keeping a good tenant was better than forcing a costly eviction. Today, human empathy has been entirely stripped from the housing ecosystem. It has been replaced by a ruthless calculation that views tenant displacement as a routine revenue optimization event. Federal court documents and whistleblower testimonies have revealed that the cartel's software was actively designed to make evictions and relentless rent hikes the absolute default setting. The system deliberately removed the human element. If a property manager actually wanted to give a struggling tenant a break, they couldn't just do it. The software forced them to file specific business commentary to manually override the AI's recommendation. The system was psychologically engineered to make blind obedience to the machine the path of least resistance. It penalized compassion and rewarded turnover. As a result, algorithmic evictions have skyrocketed, forcefully removing thousands of working-class families from their homes with the push of a button. You would think that as hundreds of thousands of people are pushed out onto the concrete, the government would step in to stop this predatory math at its root. Instead, they have accidentally created a booming, highly profitable secondary industry, completely dependent on the aftermath. The direct fallout of Wall Street's housing math is a staggering, heartbreaking unhoused population. But rather than fixing the underlying supply problem or dismantling the algorithmic price-fixing cartel, the system simply throws billions of taxpayer dollars at treating the symptoms. We have created a lucrative secondary economy surrounding the management of homelessness. According to the explosive May 2026 Department of Housing and Urban Development report, there are now over 1 million homeless individuals in America. The data is damning. Between 2013 and 2025, chronic homelessness surged by a horrifying 81%. Yet, during that exact same time frame, government continuum of care spending increased by 111%, and taxpayer-funded beds increased by 151%. The business of managing the unhoused has become a booming corporate industry of consultants, temporary shelter developers, and nonprofit executives. We are pouring more capital than ever before in human history into the infrastructure of homelessness, while the actual human tragedy on the streets continues to worsen. The cycle is deeply parasitic. Wall Street's algorithms artificially inflate the cost of living, pushing families out. The government then taxes the remaining middle class to fund massive, inefficient programs to warehouse the displaced, turning human suffering into an institutionalized cash flow. It is a closed loop of profit, which leads to a terrifying mathematical projection. If this algorithm continues to run completely unchecked, what does this country look like just 1 decade from now? This is not a temporary real estate bubble. It is a permanent, structural rewiring of American society. If corporate capture and algorithmic pricing continue at their current velocity, we are witnessing the death of property ownership and the rise of a dystopian, subscription-based survival model. We can project the data directly into the future. If the 36% spike in unsheltered homelessness seen over the last 12 years repeats over the next decade due to localized corporate monopolies, we are looking at a 2036 where nearly 1 million Americans are living on the streets. Meanwhile, the middle class will be hollowed out entirely. The ability to build generational wealth, to own a piece of the earth, will be reserved exclusively for the elite. The rest of the population will be forced into permanent, lifelong renting, where the cost of simply existing is dictated by a machine maximizing shareholder value. The housing crisis we are living through right now is not a failure of the system. It is the system functioning exactly as it was mathematically designed to. The crisis is the product. The algorithm is working flawlessly. The only question that remains is how long we will allow artificial scarcity to dictate human survival, and when we will finally decide to pull the plug on the machine.